Hi everybody, my name is Mary Redmond. I'm talking right now about the US dollar Canadian dollar pair. So it appears that this pair has made a trend change in the last several weeks, and sometimes trend changes are very dramatic. They occur all of a sudden, as we saw here with a big candlestick pivot point here or here, and sometimes downward trends can metamorphose to upward trends over a period of days or weeks without people noticing until the new upward trend is intact. And that seems to me that that is what has happened with the US dollar Canadian dollar. And there are a lot of fundamental reasons for this change. And because this is a currency pair which trades in very close relation to oil prices, because Canada is a significant oil exporter, as well as the stock market because of their kind of a proxy for global growth along with the Australian dollar. You can see that we had a very bearish move in the stock market, and I believe that this is a trend change now and what could be the beginning of a more serious and substantial correction. And if you zero into a very close term S&P 500 chart alone, what you can see what happened on Friday, we did have a big move down and then followed by a move upward, but the S&P wasn't able to close in the positive region. S&P just closed for the day flat, despite the fact that the Dow Jones average was able to close slightly positive. And if you look at the prices of oil, oil made a classic move below what looks like a very long-term, or at least year-long, head and shoulders pattern. And there could be several reasons for this move downward in oil. It's probably just in anticipation of slower global growth. The fact is that Chinese have been raising interest rates very aggressively in order to control inflation, and that's starting to have an impact on the Chinese economic reports. And in addition to that, we're seeing an increased awareness of the European sovereign debt issues, some of which are causing a big spike up in the bond yields in the European countries. And thirdly, we've had the cessation of the quantitative easing by the Federal Reserve. So you can really see the difference with the stock market, the way it's behaving, and the commodity prices, the way they're behaving, when we don't have all this liquidity being pumped in from the Fed. And in addition to that, we also had some very weak economic reports coming out from Canada last week. The Purchasing Managers Index came in at 46, which is very, very bad. It really shows that they're in a contraction now. And in addition to that, the housing prices in certain regions of Canada have taken a big move downward. The Vancouver real estate took a 21% drop in home prices in July. So this indicates that Canada may be entering what could be kind of a rough patch for them. And in addition to that, we also have the situation with the U.S. Federal Reserve meeting this week. So a lot of market participants are probably anticipating that there is going to be an additional round of what they call quantitative easing by the Fed. And nobody really knows what the Federal Reserve is preparing over the next several months. They may not even be sure themselves, but what I think is that the most likely scenario is that they're going to put out a statement which says that they keep the Fed funds rate low for an extended period of time. They keep the securities which they have purchased on their balance sheet, and they're going to monitor the situation for additional developments. The employment report, which came out on Friday, was actually pretty good. It showed over 100,000 jobs were created. And I think the Fed wants to save most of their ammunition for a true emergency situation. So it's my belief that for the time being, they'll simply stay on hold. So if many market participants are anticipating that they're going to jump right into more quantitative easing, then any statement by the Fed that they're remaining on hold could actually be bullish for the US dollar. So we also have another indicator that's interesting to look at. You can see with this small speculative SSI statistics, for a very long time, the majority of the small speculative traders were long the US dollar Canadian dollar, and they've recently flipped to net short. So that's, as a contrarian signal, that's actually bullish, because unfortunately most of the small speculators are wrong most of the time. So that is an indication that most people are short, and they could be caught in a big upward move if we do have that. So there are a lot of other factors right now. There's a lot of other things going on in the market that people are aware of. But there was an emergency meeting called of the G7 finance ministers, probably to deal with the fact that the European bond yields, particularly in Italy, have been spiking way upward. So nobody really knows exactly how this is going to be resolved, but it's likely that it's highly unlikely that there's going to be any type of a short-term, quick, easy solution. With these bigger countries, they're probably going to have to work their way through these sovereign debt issues over a long period of time with austerity, and there could be some serious problems. Some of these banks may not get paid back all of the money that they're owed by the countries which are in debt. So there's some very complicated issues to deal with in the EU, and that's causing an increase in the credit spreads all over the world, which is increasing the fear in the market. And despite the fact that the S&P downgraded the U.S. debt, the fact is this isn't going to really affect the short-term money markets, and that's what's really important. And I think the S&P downgrade of the U.S. debt wasn't really too much of a shock to anybody who watches the markets, because everybody really knows that the U.S. has a serious long-term problem with debt, and that the long-term debt of the U.S. in terms of the yields is probably going to have to be more competitive with other countries going forward. But it really doesn't impact the short-term money market funds. And in fact, the Standard & Poor's reaffirmed the U.S. short-term rating at the top level. So what that means is when investors are really frightened and there's a real panic in the market, the money that comes out of stocks or riskier currencies usually goes into money market funds. And that's what boosts the dollar, and that's what we saw last week, actually, despite all the highly publicized problems in the U.S. So for these basic technical and fundamental reasons, including a slowdown in growth in Canada, as well as a pullback in the housing market, the fact that there's been a change in sentiment, in investor sentiment, as well as a fundamental change in trend in my belief in the stock market, I do favor this pair to the upside. But it's gotten a little bit overextended, and what we want to do is always wait for a pullback. And in this case, I think it might not even pull back to the support at 97.50, but if it were to pull back, say, to 97.75, I think it would probably be a pretty good buy there. And because this pair has very low volatility, if somebody who can withstand a certain loss could actually put a stop loss here below 94, because it appears that the 94 level might be an intermediate term bottom. And if the conditions in the stock market progress the way that it's likely that they're going to, be a long-term move whereby the US dollar, Canadian dollar could move way above parity. So this is a lower volatility pair. It's not really as good for scalping. It's almost more of an investment pair. But I do favor it to the upside now because I think the tide has turned in this particular pair and in the financial markets for the intermediate term.